Hi there, welcome to Kneppy Invest. In last week's weekly update video, I mentioned ERoad because this company was in a trading halt at that point in time in relation to a fairly dilutive capital raising, and I thought the share price would open fairly or significantly lower than where the share price was. Now, the shares in ERoad have started trading again, and the share price dropped about 40 to 45% in one day on the back of this particular capital raising. Now, the capital raising itself is not the issue I have with this company and its management. It's what's been happening or what did happen leading up to this particular capital raising. And I would be absolutely livid if I was a shareholder of this company right now. Thankfully, I am not. And even if I was a shareholder of this company about 3 or 4 months ago, more than likely I would have sold out because there was a takeover bid for this company back in June. And the share price popped up a fair bit on the back of this takeover bid. I think the share price went up to maybe $1.10, maybe $1.20. And that was sort of the catalyst to take profits or take your loss and get out of this company. Because what management have done since then, since this takeover bid was announced, has been absolutely horrific. So let's get into a timeline of ERoad since the 22nd of June 2023. So we are talking about just under 3 months ago. So on the 22nd of June, ERoad did receive an unsolicited, non-binding indicative proposal, which is an NBIO, from Valaris Group, which is an operating group of Constellation Software, which is listed on the Canadian Stock Exchange with ticker code CSU. If you don't know the name of Constellation Software, I think you should do some research. And I'll show you the chart of this company. In fact, I would say that Constellation Software might be one of the best software companies, if not the best software company in the world. So yet again, the best software company in the world wanted to buy ERoad 3 months ago. And the price they wanted to buy ERoad was at $1.30. That was in New Zealand currency because this is a New Zealand based company. Then on the 12th of July, this is a direct quote from the board. After careful consideration, ERoad has determined that the Valaris NBIO materially undervalues ERoad's business. So that share price of $1 or at a price of $1.30 per share, which might be fair enough. Maybe it did, in their opinion, undervalue the company. But then 2 months later, in fact, under 2 months later, ERoad decided to do a capital raising. So on the 7th of September, ERoad announced a 50 million New Zealand million equity raise. The issue price of 70 cents per new share reflected a 50% discount to the share price the day before they announced this particular capital raising. And this does lead to some serious questions. If you believe this takeover bid for the company at $1.30 was significantly undervaluing the company, then why are you raising capital that is significantly below that raising price? Because the time you want to raise capital is when the company is overvalued, not when the company is significantly undervalued or significantly undervalued. And that's what the company is doing. Not only that, it's at a share price that is almost half to the takeover bid. An absolutely bewildering capital raising. So some people have sort of tried to suggest to me that most companies, when it comes to capital raisings, are at the whims of the brokers or the investment bankers. And I don't absolutely believe that. Now, I was listening to a podcast, in fact, this morning. I think it was called Baby Giants. And Claude Walker, he didn't say the company, but he was talking about a company. He was talking to the CEO of a company a few years ago, and he was sort of surprised that the CEO of this company was listening to brokers in terms of this company being able to raise capital in the future, and they didn't have to get to the inflection point of becoming profitable because they could keep on raising capital in that cycle. And that was at top of the market. And possibly that company was eRoad, because Claude Walker was a founder of eRoad, and then he sold his shares. And he did mention that this was the catalyst for him selling out of his shares in this particular company. Now, he did not mention eRoad, but I do suspect that possibly that company was eRoad. And the share price of this company has fallen significantly since 2021. So that is the state of affairs for this company right now. Now, let's have a look at the market reaction. Now, I did mention in last week's video that I expect the share price to significantly drop just because of the significant discount this capital raising was at. So before we have a look at, this is the video for some reason, before we have a look at the share price and the chart for eRoad, let's have a look at Constellation Software. Now, this is, as I've mentioned, this could be one of the best software companies in the world, if not the best software company. It's listed on the Canadian Stock Exchange. So this is the daily chart, which it's a nice uptrend. But let's have a look at the weekly chart, and you have a picture of how great this company has been performing. And usually the chart and the share price will follow the financial performance of a company. Now, the market cap of Constellation Software is 59 billion. Dividend yield is 0.2%. So you don't buy this company for the dividend. Price earnings ratio 90.9. So the market is willing to pay a significant premium for this company. This is the most beautiful chart you'll ever see. In a beautiful uptrend. This is the weekly chart. So the share price right now for Constellation Software is 2,871 Canadian dollars. So let's go back to 2010, even 2013. So let's go all the way back to 2009. You could have bought Constellation Software about 3 years after it listed for $26. So this has been a 100 bagger over the past 14, 15 years. Again, 100 bagger. You just have a look at the financial performance of this company. It's just, this is a company everyone should study to understand how companies can be successful. It's a brilliant case study. If you just look at the last 5 years of history, revenues have increased from $4 billion to $8.6 billion. Profits have increased from $491 million to $662. Profit margins have actually decreased, but this is, again, one of the highest quality companies you can buy. Unfortunately, again, it might be a little bit overvalued with a P ratio of 90.9. But have a look at Constellation Software, a company I would love to own right now. But the only reason I might take a position in this company is just a chart. The chart looks absolutely brilliant, just a beautiful uptrend. Now onto eRoad. Now we can look at, because it's dual listed, it's also New Zealand Stock Exchange. Let's have a look at the New Zealand the New Zealand chart. And the main reason is because the capital raising was at 70 cents. So what is the share price of this company right now? Now we're going to have a look at the daily chart. Actually, if we start with the weekly chart, you can see how much the share price has fallen. So the share price has fallen from $5.60 to 70 cents. And if Claude Walker was actually talking about this company, the share price has fallen significantly since then. Now, there is a pretty big chance he wasn't talking about this company, but maybe he was. Anyway, that's beside the point. If we have a look at the daily chart, we can see actually when this takeover bid was announced. You can see the share price in New Zealand popped up 59.7%. So this takeover bid was at a significant premium to the share price, and that's why the share price popped up. Share price kept on rising because the share price, when it closed on the day of this capital raising announcement, share price was significantly below the capital raising price. So on this day, it closed at $1.03, and the capital raising price was $1.30. So there was a significant difference between the share price and the capital raising price. So this is a market saying they don't think this takeover bid would be going through, or otherwise you would have a nice little arbitrage here. Share price was rising the next 3 weeks because the risk of this takeover not going through was not there. I think it was, what date was it? The 12th of July? Here it is, the 12th of July. In fact, when the board came back and said, we think this takeover bid undervalues the company, share price actually rose 5.4% on the day. The share price went sideways, and then the company announced the capital raising, and look what the share price has done. It was an absolutely bewildering capital raising at a significant discount to the share price. Why? because the share price was holding quite firm. Why not just do a 10% discount to the share price? Why 50%? And some again would say that's because of the broker, because of the investment banker. Just ignore them. You don't. People say you always have to do a discount when you do a capital raising. I have seen companies do premiums. There was a company called Structural Monitoring Systems back in 2014 who did 2 capital raisings at a premium to the share price. It can be done. Just don't listen to brokers and investment bankers, because they don't have the interests of the company at heart. They're just thinking about themselves, which is understandable. Anyway, share price has taken a massive hit, and share price just keeps on falling. Share price is now at 70 cents, which is the capital raising price. So again, if you're a share of this company, why would you partake in capital raising? Because you can just buy shares on market at 70 cents. If the share price falls below 70 cents, which is a possibility, you can buy shares of this company at a discount to the capital raising price. So look, there is potential. I'm going to say just potential that this company could become profitable. This company has seen nice growth in revenue over the last 5 years, almost a doubling, and more than a doubling revenue. In fact, almost a tripling in revenue. The company is not profitable. That's the main thing this company will have to prove, that it can become profitable. Let's have a look at the last. When did they release it's a New Zealand-based company, so they didn't release their results in August. So they should release their results in May and November. And did they release their results in? Yep. So they released their results in May. So the next results we'll see will be in November. And financial year 23 results delivered with guidance. Can't see any media announcement alongside these results. I do prefer to just open up the media releases because they're mostly short, but this company only released one massive document, which was 114 pages long. I do wish they would release more than one document. Anyway, so revenue 165.3 million, EBIT loss of 7.2 million, free cash flow improved from an outflow of 45.1 million to an outflow of 29.9 million. So this company is just bleeding cash. Why are they bleeding cash? Let's have a look at their financial statements. I wasn't actually planning on doing it. This is just improv, looking at financial statements. Okay. So let's have a look at the financial statements. So I have not had a look at this company at all. The revenue is really nice, to be honest with you. Here it is. Revenue, $174.9 million of revenue, yet you're not profitable. Operating expenses are fairly high, so gross profit's fairly low. Depreciation, fairly high. Amortization, fairly high as well. So straight away, you're not going to get much profit. In fact, earnings before interest and taxation, only 1.7 million. Finance expense, 7.1 million. Does this company have debt, which would be concerning as well? So let's have a look at the balance sheet. So this financial statement's all over the place. So you have current assets on the left-hand side. Assets on the left-hand side, liabilities on the right-hand side. Borrowings, about $70 million of borrowings. Well, that is a little bit of a concern, particularly when the market cap of this company is about 70 million. So one of the reasons why they might be doing this capital raising is to decrease that borrowing. So potentially, the whole reason they had to give a bit of a big discount to this particular capital raising is because the market knows this company could be under a little bit of stress because they've not backed this takeover bid. Not much cash, 8.1 million of cash. Total assets or equity, 248.8 billion. So, they have a fair bit of assets or net assets. And then the cash flow. Now, operating cash flow, 24.1. So straight away, you might go, ooh, operating cash flow, 24.1. But payments for, or capital expenditure, which is payments for investment in property, plant, and equipment, 27.5 million. So straight away, this company is not free cash flow positive. And payments for investment in tangible assets, 28.2 million. Now, that capital expenditure and that investment in tangible assets, which I believe is capitalized research and development, are fairly high each and every year, over $50 million each and every year. This is why this company is burning through a lot of cash. They really have to do something with their spending before they even think about becoming profitable. So I would be concerned if I was a share of this company, just because they are burning through a lot and lots of cash. We can open up the investor presentation. that went along with this capital raising. And main thing is I want to see if what they're going to do with this capital raising, the money they raise. What are they going to do? So, recapitalizing our roadmap for growth, market update and equity raise. Let's have a look. Use of proceeds. Oh, well, so straight away they say here, the capital raising will strengthen ERoads' balance sheet because they do have a fair. Well, gee, what happened there? Will strengthen ERoads' balance sheet, positioning it with flexibility to continue, blah, blah, blah. This because they have a lot of debt. Net proceeds from the equity raise will result in an increase in funds available to 65 million, a reduction in net leverage ratio. Secured commitments for a new 3-year debt facility. Just wish they didn't have any debt at all. Yeah, so I'm not going to go any further into this particular capital raising. I think it might mean it's more, the company is more secure, but the very fact that it was done at a significant discount to the share price and a significant discount to the takeover bid does not fill me with confidence. And I would expect that shareholders were absolutely peeved off by this particular cap raising. I have seen it. A few companies do this. Big Tin Can was another company that was under a takeover bid, and then the company did a capital raising at a significant discount to the takeover bid, and shareholders were not happy. I could go to Copper just to see what shareholders are thinking about this capital raising, and I would expect they are not happy at all with ERoad. Anyway, actually, I'm gonna see if they mention anything about trying to get to profitability, trading update. New Zealand business has a solid track record of growth and free cash flow generation. Excluding temporary costs associated with 3G replacement program, ERoad would be free cash flow positive today. I don't know about that. So financial year 24 guidance, revenue 180 million, normalized EBIT 0 to 5 million. So that actually does include amortization, research and development spend, 30 million. That's a lot of research and development, $30 million. Anything else I want to? No, nothing else here. Anyway, so that's really all I have for this particular rant about ERoad and their equity raising, which was done at a significant discount to a takeover bid. I think this is ridiculous. I understand that management might, particularly if they are founders of the company, which I don't know, they could be founders of the company. They do have a place in their hearts if they are the founder, and they don't want to sell this company because this is their child, that sort of thing. And they just think $1.30 was absolutely disgraceful price to sell this company, even though it's to Constellation Software, operating group of Constellation Software. But the very fact that they did a capital raising at half the price of the takeover bid is it just blows my mind. They didn't have to do it at this discount. They could have found ways, because the share price has fallen down to the price of the capital raising, which just blows my mind. Anyway, that's all I got for this video. If you do have any questions, any thoughts about ERoad, I'd love to hear your opinions, so leave them in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.